So if I just may take a moment to welcome and thank all of you, both the chairs, Niti and Mariam, and of course the two speakers, Semen and also Chuai. I also acknowledge the presence of Eugenio, who chairs the ESG forum together with Mariam. And this is the second in the series, I believe, of the event that ESG is doing. It took us about 6-8 months or a year to get our feet firmly on the ground. We've done as ESG papers at 2 conferences. The third one is around the corner, and we thought it's time to start some other initiatives, and one of them being these conversations with expert minds, with scholars who have been working on areas of topics of interest with to the younger and to the budding scholars and even seniors like me for that matter, and to be able to learn from them. And this topic in particular, I'm so thankful, Eugenia, Maria Maniti, you chose, because this is a topic which, of course, is of great interest, not just to India, but to many other economies and countries, markets. But in particular is of growing interest because UNCITRAL is the UNITROIT is working on it. And yesterday, I got an email in my box today that they have finalized the final draft and the guidelines. The guide is being worked on, and hopefully that also will be live in about 10 days time on the website. And so therefore, it's just a great time for us to be able to talk about this. I will, I'm not an expert on this subject, but this definitely interests ILA a lot. And we have a number of initiatives ongoing in this topic. And I do look forward to listening to this conversation. And I'm sure everybody who's joined would enjoy it very much. Eugenio, may I request you to say a few words before we just hand over to the chairs of the session today?
Thanks, Sumanta. I don't have to say anything about the session itself. I will leave the floor to Mariam to introduce the session. I just wanted to remind everyone to join us for the third Insolvency Law Academy conference in New Delhi, and that's about it. So, Mariam, I'll leave the floor to you unless Sumanta wants to add anything.
Thank you so much. Over to you, Mariam.
Okay. Hello, everyone, and thank you for joining us. I'm Mariam Zaidi. I'm the Senior Legal Manager at Piramal Capital and Housing Finance Limited, Bombay. And I'm also the co-chair of the Emerging Scholars Group under the Insolvency Law Academy. It's an honor to co-chair our second virtual panel meeting on bank insolvency. I am delighted to share this platform with my esteemed co-chair, Professor Shimin Gao, who's also the Associate Professor and Vice Dean at Tsinghua University, China. Professor Gao, who's a doctorate in law from the University of Pennsylvania, brings exceptional expertise in bankruptcy, corporate, and financial law. Her research, published in leading journals such as American Bankruptcy Law Journal, International Corporate Rescue, along with her editorial, promises to add exceptional depth to our discussion. Joining with us today, we have 2 eminent speakers. Firstly, I would like to introduce Dr. Niti Shikha, who's a renowned academic, a practitioner in insolvency law and corporate governance. With international experience across India, Singapore, and UK, she has contributed significantly as the founding head of the Center for Insolvency and Bankruptcy under the Government of India. Currently, she's a faculty member at Bristol Law School. Dr. Shikha is also a member of the Insol Academic Sterling Committee and an editor of the International Insolvency Review. Our second speaker is Dr. Shuai, who's an assistant professor at the China University of Political Science and Law. He is a leading expert in cross-border insolvency and bank resolution. His academic contributions, including consulting for UNITROIT and publishing in journals such as International Insolvency Review, reflects his expertise in shaping the legislative reforms. With such a distinguished panel, I'm confident today that we are in for an insightful and engaging discussion. So now I would like to move on to asking Dr. Shikha our first question. Dr. Shikha, what do you think is the current insolvency framework under Section 227 of the Indian Insolvency Code sufficient for financial service providers? Or do you think there is a need for a comprehensive standalone resolution framework for banks and non banking financial companies?
Thank you. Firstly, I'd like to thank ILA for inviting us for this very interesting and timely conversation on bank insolvency framework, and especially to Eugenio, Mariam, and Simin. Thank you so much. Before I start talking about the IBC, it's interesting to know that around the time in India, when IBC was introduced, there was another very interesting piece of bill that was introduced in the parliament, and that was called the FRDI bill. Apparently, FRDI bill could not see the light of the day till now. We are still hopeful to see this in a revised avatar, but it's interesting that while the legislature was probably mulling about having a comprehensive framework for insolvency of corporate persons and natural persons under the IBC, the idea was that for the financial institutions, the bill, FRDI bill, if it would have seen the light of the day, would have been, the piece of law or legislation to go to. Now, FRDI bill was, it was called off because of a lot of political conversation that moved around it, which was not very popular. And as you would know, that lawmaking is just not about getting the economics or law right, but also making sure that's politically correct. And the main concern with FRDI bill was the bail-in provision. Now, Vidhi Center for Research, ILA itself, and many researchers like myself, we did work on FRDI. Interestingly, during my tenure at the center, we got a funded project from the Ministry of Corporate Affairs where we tried to read the FRDI bill to understand where it went wrong. And the idea was that, do we really need to rebuild a new framework, or was that framework good enough and maybe it just needs a tweak? That was the idea that we were studying, with the objective we were studying. And we studied over 36,000 FSPs in India to see how they differ from each other, what kind of stress they feel. I'm not going to bore my audience with the details of that paper, but the point I'm trying to make here is that initially it was thought that there'll be a separate piece of legislation for financial institutions, and rightly so. Now, FRDI bill in the erstwhile bill, if you see, it tried to really bring itself as close as possible to the best international principles. If you know, post global financial crisis, G20 countries came together and they introduced something called FSB key attributes, Financial Stability Board key attributes. And the idea was that, in a globalized, interlinked world, the countries who participate in this intertwined financial market, they make sure that the regulations that governs banks are of the best standards, and also are harmonized to large extent. So FRDI bill was, it had its some limitation, but it was trying to get itself as close to the international best practices. Now, after the bill was recalled, there was a vacuum of legislative framework for financial institutions in India. And if my audience would remember, that was a time when a few financial institutions had failed, and it became a concern for the Indian economy and Indian legislators and the regulators. And I think it was the INFS case that sort of triggered to find a stopgap solution to resolve that problem. Now, if we look at the IBC code, of course, under the section 227, the government has the power to announce which of these, entities could be resolved under the IBC code. And it used that power and make a stopgap solutions for NBFCs over 500 crores, to be resolved under this. I'm not going into details of what the section is and how IL&FS, it's an interesting, curious case that we witnessed in India, and it was a stopgap solution that the legislator made. Now, coming to the question as, is IBC enough for the financial institutions? My research so far and my understanding of financial international best practices and the financial market in India as such suggests otherwise. I think that it'll be regressive for us as a country to rely on IBC as the gateway to resolve bank insolvency. I have been into conversations and discussions earlier where very eminent people have suggested that it should, but I have strong reservations. And most importantly, because banks and financial institutions are very different type of, entities or animals in a gross word that we talk about. They're very different. The kind of risk they face is different. The kind of activities they take up is different. Within the banks and financial institutions, we have insurance companies, we have small banks and medium enterprise banks, we have NBFCs, and most of these are catering not just to the big financial market or capital market. Many of them even cater to the rural economy. So the point I'm trying to make here is that because the nature of those entities that we need to govern are different, we need to make sure that the insolvency framework is designed to suit that kind of nature. The second point that I'd like to state is that today, if you see, India is one of the leading, is the fastest growing economy, leading economy. And in that case, we have to make sure that our laws are aligned with the international best practices. And in the current framework that we have, and if in IBC, which is more suited for, corporate insolvency, banks as an entity would not fit in there. My last submission, I know we'll have more time to talk about it in details. My last submission would be that it's the way that insolvency framework globally is moving is that it is having a very sector specific approach, and the rationale, maybe rightly so, is because one size does not fit all. So because of that, I think it's important to make sure that the insolvency framework, which is designed for banks, suits the nature of the services that banks perform. Even banks which are private banks and may not be listed banks, nevertheless have huge public interest involved, which may not be the case for many corporate entities. We may have a very small localized businesses. So I'll just stop with my comment here that what we saw earlier was a stopgap approach. It was a temporary approach, temporary arrangement. And what we need is a very nuanced and a nuanced and detailed framework for financial institutions, which is aligned with the international best practices.
Thank you, Dr. Shikha. Now we would like to know, Dr. Shoy, your take on the international standards and what do you think? What are your views on the standalone practice from the international point of view?
All right, thank you very much. First of all, like Niti, I would like to thank the Insolvency Law Academy and for the organizers, Sumo, Eugenio, Mariam, and Sumi, of course, and also very nice to see my co-speaker Niti here. I actually very agree with Niti what just described about the specifics of banks. And from my point of view, like banks are very different from normal companies. As firstly, its operations relies on like large sums of deposits, which are short-term liabilities that could need very liquidity resources. Well, on our side, it's assets are mostly loans and like long-term assets that could be problematic when a bank fails. And secondly, banks provide very critical social and functions such as payment system. And nowadays, everyone uses banks to do their daily shopping and consumer things. So that's very important to the society. And thirdly, as more macroeconomic point of view, banks provide this kind of intermediate services to central banks. I mean, commercial banks provide intermediate services to central banks, which is the implementation body for those kind of monetary policies, which are like very critical for the health of the economy. So that makes sense. So I agree with Niti that banks are different from normal companies, and that's why at an international level there are different regulatory and the principle from normal corporate insolvency laws that special rules need to be in place for banks. Actually, I also very surprised to see that India has no specific bank insolvency law at the moment, especially as a large economy as in India. As a matter of fact, as I know, before 2008, there were quite a lot of jurisdictions that have adopted this kind of court model, like applying normal corporate insolvency laws to financial institutions, especially in the EU. Of course, the big change happened in the 2008 financial crisis. And there came what it just mentioned, the FSP key attributes for effective resolution regimes for financial institutions, which established a administrative resolution regime for failing banks. And that allows to the financial resolution authorities, normally administrative regulators, to directly intervene in the operations of failing banks. Having said that, those kind of failing banks, what we usually call them as systematic important financial institutions, SIFIs, or what we call like large banks, so we can understand in that way, fall under this kind of resolution framework. And afterwards, for example, the US Dodd-Frank Act expanded this kind of resolution framework to large financial holding companies. The EU completely changed the previous law and introduced the Bank Recovery and Resolution Directive, BRD, and a Single Resolution Mechanism Regulation, SRMR, to establish resolution authorities, and in the EU, the Single Resolution Board, SRB, to all the types of failures of banks. But there's one condition, that is, those banks are normally systematically important banks. And why is that? Because we have said that banks operate differently from normal companies. And since we are introducing a special resolution regime into the failures of banks, that means we need strong justifications from a legal point of view to have the direct intervention of those kind of financial regulators. And that's the reason why the current resolution regime mostly focused on large banks, because that could put our financial stability at risk, that could cause contagion effects, and that could have like systematic instability. And that's why the reasons or the legal justifications have this kind of special resolution regimes in place. However, I think Niti also mentioned that but in normal, our business day, not only large banks that provide services, but also smaller banks, we call small and medium-sized banks, that are in place. And the failure of those kind of banks could also put public interest at stake. There are always numerous deposits involved, a lot of people investing, and that could have some social impacts in that. Given the severity of these failures of smaller banks, I think, as Suma just mentioned, the National Institute for the Unification of Private Law based in Rome started this bank insolvency project, which is limited to supplement the existing key attributes and to address the failure of what we call smaller banks. I had the privilege to be involved in the project and helping drafting some of the legislative guide on bank liquidation. And we have this starting point that all banks could have some systematic risks regardless of their size, not because they operate in a way that provides great substance, but because the reason that we every day everyone faces that they are everywhere in our daily lives, and the failure of even one smaller banks could put our society at risk. So that's why we still think normal corporate insolvency laws are not sufficient to address the failure of smaller banks. That's why I came into the universal principle, universal guide on bank liquidation. Well, we are focusing on the bank liquidation part, and we are introducing this kind of piecemeal liquidation tool, which is different from normal corporate insolvency law. In the liquidation, we end up piecemeal liquidation and selling and those kind of assets piece by piece, which means we cannot get the maximum value of the debtor's assets. But for banks, we need to keep it to critical services and functions banks provide, and we want to swiftly transfer those kind of critical functions and values to a third buyer, bridge banking institution, things kind of thing. So we introduced or we advocated for this kind of transfer tools for this kind of thing. And since we are doing this kind of non-piecemeal liquidation as transfer tools, preserving the core values and the functions of financial institutions, that means the authorities in charge of this kind of process might be needed to be differently from normal corporate insolvency laws, which are normally the courts. Of course, I believe our judges have sufficient knowledge about financial institutions, but they're constrained with our statutory laws of of corporate insolvencies, about limits and about this kind of balancing different interests that may not meet the needs of swiftly resolve the failures banks in a very quick and efficient way. And also, normally the information, the financial information about the failing banks are in the hands of financial regulators instead of courts. So financial regulators may in a better position to have first knowledge information to get the potential failures banks and directly intervene in the process. So such, I think most of the attendees argued or agree that a special semi-restitution regime should also be in place for smaller banks with the involvement of administrative authorities. However, we still respect different jurisdictions' choices. I know maybe the India is still relying largely on corporate insolvency laws and on judges. Of course, we would respect each jurisdiction choice, but it was strongly recommended that financial regulators should be involved in the failing or resolution process of all these kind of banks for the specific reasons I stated above. I think I will stop here and give the floor back to Marion. Thank you.
Thank you so much, Dr. Shnoy. Now, I would like to move on to Dr. Shikha and ask her, what lessons can India and other jurisdictions learn from the 2023 Silicon Valley Bank and Signature Bank to improve the crisis management and resolution frameworks? We would like to know your views.
Thank you, Mariam. You have asked a question which is very vital and very important for all the regulators across the globe to think about. And I say so because, until 2023, late 2022, we were the main concern of the regulators across the globe was to control too big to fail institutions, banking institutions. In 2023, we saw that the banks that failed, they were not systemically important banks. They were not too big to fail, but nevertheless, they were very important and they had a big role to play in the global economy. Now I think is the time to talk about not only too big to fail, but too many to fail banks. Though the contagions was controlled and India arguably did not see, a direct impact of SVB Bank failing. In fact, kudos to the way Indian economy was, that we did not see any direct impact of SVB Bank failing. Of course, economists could disagree with me, because any bank as big as SVB, though not systemically important, but very important for tech industry, which failed, would have an indirect contagion on Indian bank. But I think if we take a step back and think what was the impact of SVP, I would reserve my comments on the global impact. But looking at why India did not have a direct impact was also because the tech markets in India had relied a lot on the domestic capital. And if you see, we were not having that kind of exposure. To say that when we're not having that kind of exposure to that bank, which also means that we were not, a market still has to grow. I mean, in a very polite way, let me put it, we are still getting there. So now the question that the regulators have to mull is that, what were the critical issues that we should now take a step back and think about? And the issue that we really have at hand is thinking about, firstly, banks which are not systemically important, but nevertheless, are at the core of the economy, the national economy, just like the SVP was. And secondly, what about, protection of, uninsured depositors? Now, there have been critique of SVP Bank. In the UK, where I am working, I've seen that the regulators have handled it really efficiently. On Friday, it was announced that one of the high street banks would take over. By Monday, everything was closed, and there was no bank run, so to say, and things were handled really well. Now, but the question or the critique of SVB Bank that has been discussed quite at length was, what about uninsured depositors so far? Because of the public interest involved in the big banks, which are too big to fail, the focus of the regulators and the policy has been on depositors' protection. But in SVP, it was, it was not just the insured depositors, but also uninsured depositors, which were at the helm of affairs, who needed to be protected. I'm reminded of a very interesting quote, which says that, when a measure becomes a target, it fails to be a good measure. I think what has happened so far is that we have been focusing so much on the target of, with all respect to big institutions, FSB key attributes, making sure that, CAR is, kept under the guard. But we did not really think about the uninsured depositors, which may have nevertheless a big impact. Now, for India, what is there to learn? India has two things to learn from it. Firstly, though SVB Bank was a crisis of systemically non-important and non-insured depositors, to begin with, we're still lacking in making sure that we have enough protection for deposit holders. So while in other countries, the global debate has moved beyond deposit insurance depositors, because the threshold in those countries are sort of enough to protect the deposit holders, so that they could avoid the bank run to some extent. But here we are. I'm equally concerned about the deposit protection for the regular depositors in India, which is as low as 5 lakhs. So I think that is something we really have to mull about. We have to increase the deposit protection beyond 5 lakhs. 80,000 pounds in the UK, over 200 pounds in the US, and it's not something that that's something that is enough for the regular depositors. Now, having said that, in protection of what India had, the small deposits are protected in India, because the small deposits usually, for the smaller rural banks, may not go beyond 5 lakhs. So the small deposit holders are sort of protected, and in fact, to a large extent, fully protected in India. But then I'm talking about the big cities and the banks, the bigger banks that operate. Now, SVP has also started the issue that raised was about what about uninsured depositors and who should bear the cost. In the literature, there have been conversations among the scholars that who should bear the cost of, of SVP failure. Should market bear the cost, industry bear the cost, or public bear the cost? This is a long debate. I think we can come to the question later, but I think this is something which, as we as a country, should start thinking about, because if you see, deposit protection threshold being low in India, as low as 5 lakhs, and then if there is a crisis, which raises, a concern for regulators to how this treatment should be, in case, in light of the newer framework that are emerging, could be a problem. Now, currently, it's not a big crisis. And why I say so? Because, and also to just clarify and add to what I told earlier, Shwai, that Banking Regulation Act in India, it allows the central bank to take care of any, happenstance with these smaller banks. So under Section 44A and 56 of the BRA, Banking Regulation Act, central bank can take a decision to adopt several measures to safeguard bank, which primarily has been the merger approach in India. So if you see that most of the banks, they have been a forced merger. The way we have forced marriages in India, the way we have arranged marriages in India, banks may not be happy doing that. The healthy banks would say, why would I take your debt? But regulator has come up and say, this is an arranged marriage, live with it. And it has worked. I mean, arranged marriages have worked in India. Arranged mergers have also so far worked in India, right? I'm not aware of any economic, cost benefit analysis of that, but so far it has safeguarded the country. The problem will rise when the economy becomes more global and grows bigger. So I think a couple of things that I'll signpost here is, firstly, think about uninsured deposit holders. How do you treat them? Think about, and this is for the regulators and the legislators, think about how you treat the deposit insurance holders. The threshold is pretty low. In fact, the study that we did for the ministry, it also, it highlighted that it has to go more than 5,000 pounds or 5 lakhs. That is the current situation. Also think about, the effect of the information. It's a very critical debate between the technology and the news and the rumors. How do banks and markets act upon that? Because if you see in the SVP's case, it was, there was a bank run because of some news on the social media. So, and this is a very critical, in fact, a very, debatable issue as to how banks safeguard themselves from rumors, from this, bank runs in the long run. And especially in the times today where, media information is all free, how quick they need to act upon that. I feel that if the news travels timely, you can avoid bank runs. For example, in the UK, news traveled timely. The regulators quickly stepped up to say what they intend to do, and a very quick, resolution was adopted. So the contagion was less. So long story short, India has to think about a proper framework. India has to think about systemically non-important banks. It also has to think about uninsured depositors. And yeah, that's it. Thank you.
Thank you so much for the insights, ma'am. Now, I would like Professor Gao to take charge and give her reflections on the discussions given by our two speakers, as well as take charge and ask her questions to the panels.
Okay, thank you so much for Maria. It's my great pleasure to join this panel discussion. So we can find we have very interesting discussion from two speakers. I want to give a little bit reflection, follow up the discussion and also raise questions to the two speakers. As far as we know, in the 2008 financial crisis, the bailout solutions has received a significant attention because the bailouts were arguably very effective at stabilizing the financial markets. However, it also has
I think we have lost Simin. She's joining. Yeah.
Yeah, we're just gonna wait for Professor Shimin.
Yeah, I come back. Sorry, my signal and my apartment is not very good, so I will just repeat my reflection and my questions. As far as we know that the bailout was arguably very effective at stabilizing the financial markets, but it also has been criticized for leading to the moral hazard and also where previous the redistribution. So as a result, we know that the U.S. Dodd-Frank Act and also the EU, the Bank Recovery and Resolution Directive has introducing the bail-ins. However, there are also a very important concern raised from introducing the bail-ins to make the cost distribution more market-based and fair. Some people argue that the possibility of the bail-in haircuts will destabilize the financial markets. So I would like to ask a question to Nitid about your opinion on the debates on bail-in and bail-out, especially for a developing market. What kind of solutions would be better for them for allocating the cost for bank failure in those markets? And so the model be different, in the developed market and also in the developed market. Okay.
Thank you. Thank
So
you, Sim.
Yeah.
Firstly, it's so good to see you. And thank you for your question. I was listening to a very interesting economist today morning, and Ruchi Sharma, who is a Rockefeller International chairperson. And listening to him, I was reminded of the classical debate of free market, which has been banks have been the biggest driver and recipient of free market. So I was listening to the debate and I was reminded of, this very question that you asked, that how do we look at bail-in versus bail-out debate? Debates have been shaping up. Classically, if you see, we have always, economists have always suggested against bailout, especially because it's been taxpayers' money which is used for protecting banks, which may have a public function but necessarily private. But over the time, if you see that bailouts have only increased, in fact, in the US, as Ruchir was mentioning, that it was only a tinkering in 1920s when few communities bank failed, and the idea was the government was still mulling whether to protect them. But post World War, what the US has seen is it is forgiven that the governments will bail out the banks, and especially in an economy like US, which is free market. And one thing that I sort of take from listening to that conversation, and what sort of the other class of economists have argued is that for a market to function, there has to be a market solution. It's important to leave the solution to the market. Now, when I say that we have to have a market solution, which necessarily means there should not be any government bailouts. Now, looking at India, and let me just first talk about the Indian scenario and why India has done what it has done. Just to give you some numbers for information of our audience. Now, bank failures is not something new for India. In fact, if you see, in 1993, 14 banks that were floated, and in 2013-14, the banks floated, 50% have bitten the dust. In 2019, 11 out of 21 public banks, were put under prompt corrective action, which is like a red warning issued by RBI that, you please clean your books, clean what you have been doing. Post 2014, six banks, six cooperative banks were closed. So what we gather is that there have been consistent bank failures, and the ratio is for smaller banks and the medium banks are pretty high. Now, two things we need to remember in the Indian context is that while these smaller banks or medium banks can be, private banks, they also fall under state legislation. So India being a federal country, there are two regulators. One is a central regulator, which is the RBI, and they also are under the purview of the state regulators. Now, the fact that, the state supervision, it has a ramification. It doesn't only have a economic ramification, it also has a political ramification, because if the state governments don't save them, smaller banks and banks which may have a very localized deposits, say in a particular state, then they are, they fear losing the elections. So for small and medium banks, which are under state supervision or even central bank supervision, because they were dual supervision, as much as RBI would want them to sort of to take the brunt, the state government may push for, saving them, because it is equally important as a political issue as much as an economic issue. So bailout, even if you don't want to have a bailout, you'll have to have necessarily a bail. You may adopt for a bailout. Let me put it this way. Let me rephrase. You may have to take a bailout or give a bailout to the banks because there's a political, interest involved as much as economic interest. Now, India so far has escaped these big issues because of the merger approach that I talked about. And most of the big banks have not really adopted for the market solution, so to say, which means that, we, in a free market economy or in a liberalized economy, we would say, let market decide what should be done with the corporations. That has not been the case in India. Regulators have stepped in, and to some extent, rightly so, to help the banks revive. But the bank revival has not directly gone on taxpayers' money as a bailout. However, there have been healthy public banks taking, absorbing these non-performing assets of the failing banks. Now, this also leads us to the larger question that the indirect effect of this approach on the economy has not been very healthy. Now, bail-in versus bailout, which is better? Ideally, as a libertarian, I would say, of course, bailout is wrong. Bail-in should be there. Then the question is, how do you make sure that bail-in is successful? Now, in one of the reasons why the erstwhile FRDI bill was called off because of the bail-in provision, because the message that went to public was that depositors will have to bear a brunt of it. So if India has to really adopt the ideal, firstly, I'm not sure if there's an ideal solution, but if at all there is one, and if it sort of tilts towards bail-in, two things needs to be done. Firstly, your deposit insurance, protection has to go up so that depositors are sort of safeguarded. Secondly, what has to be done is that a clear planning has to be done, that it's not the per se depositors, but the banking industry that sort of takes the charge or the brunt of the failed bank. But I'm also aware that if that means that the cost of banking would go up, I'm also aware that if that has to be the case, then the interest rates would go up. But on the flip side, interest rates would have also gone up in the US, for instance, because of the, public bailouts. So I think we're looking forward to the, what Unidroit is suggesting for these small and medium banks. And maybe we'll find, a midway solution. For example, there was a case in India where a big bank failed, but a Singaporean bank stepped in, which wanted to have a market access, and they got, a good number of retail investors. And it was a it was a happy marriage for both of them. So I think if we have something like that that works for the market, which is good, ideally and in principle, I would still say that public bailout should not be, because while in the short term, public bailout does gives a feeling of comfort, but in long term, its impact on the economy is very harsh, and we have seen that that case in many countries where the impact of economy, the inflation's really gone up, and that's not ideal for any economy. If the banking industry has to take the cost, if you've seen after SBP, the contribution of banks to the insurance as an industry has gone up, and in some cases increased by 50%. So maybe banking industries have to find a way to make sure that the industry itself faces the laws, and ex ante they increase their contribution, and ex post they have to find newer ways to deal with the challenge that emerges. Thank you, Simin. Shivai, Simin is not around. What are your thoughts on this?
Thank you very much. I also like to say something about the fundamental debate about in and out. Of course, I could take the Chinese example to illustrate my thought of that. I do believe that's the fundamental question we need to think about as the banking insolvency lawyers. So what kind of solutions are needed for this kind of crisis, and what I must say. From my Chinese experience, actually, most of Europe and from India, most of the enterprises are state-owned, so we have a strong state-led economy model. So back in the days, even before the now what we call resolution framework, we do involve the governments, so government officials in the process of resolving failing banks. So the first bank failures happened in 1998 about the Hainan Development Bank, which is a province very close maybe to India too, because it's in South. And that's when a bank fails. Before our commercial bank law was enacted, some ad hoc measures taken by administrative authorities involved to deal with the problematic assets and liabilities. And since the 2003, the enactment of our commercial bank law and bank supervision law, we introduced a similar receivership procedure to the U.S. Deposit Insurance Corporation Act, and we allow financial regulators to take over the liabilities and operations of a failing bank when there's a big credit crisis. But that haven't been used very often, and maybe probably none for banks. The next bank was happening in 2019, but at that time we have seen this already after the 2008 financial crisis. So China gradually adopted some of the international standards, including involving recovery and resolution plans, and also adopted the Deposit Insurance Act, so created a deposit insurance fund to help rescue the failing financial institutions. So that's what happened in 2019 about the Baoshan Bank. So we applied both the receivership while the financial regulator took over the operations of the failing bank, split them into half, and transferred them actually to two different buyers. One is a bridge bank actually, and also use the deposit insurance fund to help the depositors to rescue the depositors. However, what we have seen in that case is a little bit similar to the question or the problem we see in SVB case, because the money more than the threshold to rescue actually uninsured depositors. Maybe we could justify this as a systematic risk, because that put a lot of stakeholders at risk. But still, it's, to my understanding, legally speaking, is very difficult term for the regulator decide, and even for judges, it's very difficult to decide what is really financial risks, what is really instability of the financial system, and you need to take in account not the time of the court opening proceeding, but the time when bank failed. At that time, you need to decide within 24 hours, 48 hours to how to swiftly act, respond to this crisis. So back at that time, I think the regulators may have made their choices, but we came back again with the fundamental question of how we can use money. Now we put like two kind of money into that regard. We have first public money, which is taxpayer money from most like Ministry of Finance or central banks. Also, we have deposit insurance fund. I think many jurisdictions have established that. And those are industry funded money. However, normally they are used to save insured depositors, not uninsured depositors. So there's a huge debate, I think, in the US also about deposit insurance regulators about whether they should increase the limits or just lift the limits of this kind of deposit insurance. But that's one of the debates of that. But that reflects one of the core and fundamental debates about whether we should use this kind of public money or industry money to save this kind of failing financial institutions. The reason against that is, I think, just to seem right to correctly characterize that moral hazard, like leaving the directors and managers having this kind of thinking that they may not need to pay more attention to the regulations as long as the government can bail out or send money for their mistakes. And on the other hand, I think for bail-in, that's the proposal started after 2008. There is also opinions that they could increase the borrowing cost of those financial institutions. And also it is in line with the post financial crisis financial regulatory reforms, for example, at the Basel III and the Basel Committee on Bank Supervision. They put higher supervision standards for banks. That means banks need to maintain more capital. They need to have more compliance cost. That could also reduce their competitiveness in that regard. And I think that's one of the reasons why during the last Trump administration, the US also relaxed a little bit about the financial regulation in that regard. So there's always debate about, yes, we do not want to bail out because that could cause more hazard, that could cause very risky investing behaviors. But on the other hand, with bail-in, with more stringent financial regulation guidelines, that could like this put more operational cost for banks, and that could also not so market friendly in that regard. So basically, I think we're trying to find a middle way to solve the problems of financial institutions. And that's why we are also having the huge discussion in China about, I think, establishing our financial law. And before that, we were also discussing about establishing a specific financial stability law for all the financial institutions, because that's a core actor in our financial system market economic participants. So back to from this kind of I just wrap it up. Just back to the question about the reforms and also about a bail-in and a bail-out. I think what I proposed also in some of the recent publications, we found a middle solution to balance the different interests of the stability of the society, also the free markets and the operations of the market participants. And we need to have some certain mechanism or concrete legal rules to establish kind of balance, including a list here, the definition of systematic risk, a clear mechanism for bail-in and bail-out, operational guidelines, also the very clear mandates of depositing insurance and depositing insurers about how they could contribute to the funding of the resolution or insolvency of financial institutions, and what kind of depositors or creditors should be rescued. In this process, I think mostly we want to rescue those innocent and vulnerable creditors like small depositors, but we leave the judgment of large companies, wealthy consumers for the risks to themselves, to have them, to push them have more financial risk ideas in their mind before they're making their investments. I think that's also this kind of different mechanisms to balance the bail-in and bail-out debate, and also to preserve financial stability, but also to make sure our banks and financial system can thrive in this process. I think that's the one I want to share for the moment.
All right, thank you so much for Shuai's discussion, and thank you all for the two speakers for the wonderful discussion on the debate on bail-in and bail-out. I think we used up all the time for this session, so it's time for us, Maria, to close today's discussion.
Yes, thank you so much for making this roundtable a very resounding process. And the insights shared today by both the speakers and Professor, they've been very valuable. And we look forward to continuing these important discussions in the future as well. Thank you. Thank you so much.
All
right, thank you everyone. Bye bye.
Thank you. Bye bye.
可以直接下线吗？因为我不断的断。